Time now for On the Radar, when we ask an investing professional what they're looking at in today's markets. We're back with Paul Harris, partner and portfolio manager at Harris Douglas Asset Management. Paul, your outlook on the markets is not constructive for the midterm anyway. You see markets declining from here. How should investors be positioned?
Right. So I think, obviously in the stock market, people tend to be very irrational. They buy when it's going up and they sell when it's going down. And I guess from my perspective as an investor, and if you have a long-term time horizon, these are great opportunities to really, if you're buying individual stocks, it's a great opportunity to do research on companies and buy great businesses at great valuations, right? So that's one thing. And if you buy the indexes, this is a great time to dollar cost average. So from my perspective, this is a great opportunity to invest in the stock market. And you're never going to catch the bottom or any of those things, but you can buy really great businesses at great valuations. That's what I think about. We don't do indexes at our place, but so that's what I think about. And I think that there are places to be where you can do that. Healthcare is a great area. So we own a company called Novo Nordisk, which is a Danish company that really is the largest supplier of insulin, but it's also come out with a obesity pill. And that's showing great, fantastic growth for them. And obesity is one of the fastest growing, it's considered a disease now. I think it wasn't before, diseases in North America. So there's great opportunities there, right? So, and then we own an animal healthcare company called Zoetis, which is it has livestock as well as pets, and that's a great business because one, there's not a lot of generics and there's not a lot of insurance, so people pay out of pocket. So they've got some really great products in their pipeline coming out over the next several years, and so I think that is the average person spends about $3,000 on their pet. So it's really a great growth business, and they only have 2 or 3 competitors who compete with them. So it's one of the few companies that can actually show reasonable growth over the next several years. So
we're just showing Novo Nordisk. It took us a bit to catch up with you there. Novo Nordisk is trades as an ADR in New York, NVO on the New York Stock Exchange. That's a pharma company, so it's a player in big pharma. Yes,
and so it really has several other aspects, but the biggest aspect is insulin for them. And the second, and the thing is this idea of this obesity pill, which they compete with. I think Pfizer has one as well. But so I think that's really where their growth is coming from. And so I think it's, healthcare is an area that I think you want to be in this time, in this period in the stock market. It's defensive and it protects you. And Zoetis is another company that is able to do that as well. The other thing I do like is, I do like financials. I know people are worried about a recession, but banks are in much better shape than they were years ago, where they have lots more capital, they have great dividends, and I think they can manage through a difficult period. If we go into a recession, I think they'll be able to do well, but I think that the dividends aren't certainly going to go away, and I think that helps you through a period of volatility. So I think Canadian banks, they're not trading at high multiples. I think they were great to be in. And some of the U.S. banks, we own Bank of America, we own J.P. Morgan. So I think those banks are banks that will continue to grow over this period of time. They've got strong balance sheets, and they can make it through a difficult period of time. So I think I like the banking sector in North America. We own lots of Canadian banks, and I think that Canadian banks will continue to do well.
And you also like a company called First Service. You've liked this one for quite some time. Talk to us about First Service.
Well, so First Service is I guess it falls into a real estate play, but they have 2 businesses. One's a franchise business, so they own California Closets and Paul Davis, and they also own, and they're a property management business. And so what they've grown over the years, and they're primarily a lot of in the U.S., so what they've been able to do is grow organically, but also make acquisitions. So this is a great time for them, I think, because one, they can buy businesses a lot cheaper than they were maybe last year. So that they will continue to do that, and they've done a great job of doing these tuck-in acquisitions. The great thing about this business is that there's not a lot of capital expenditure. It's a capital light business, and they have the ability to. They're small players. They're one of the largest players, but it's still a very fragmented business. So there's lots of opportunity to grow, especially in the U.S. So I think there's it's a great way of, I think it falls into real estate, but it's really a great way of playing a good servicing business where, and it's also a bit of annuity. When you sign a deal to, cut your lawn or manage a building, you actually do that over several years, and there are escalation clauses for inflation. It's maybe not as high as it is today, but they do have that escalation clauses in their contracts. So it does protect them a little bit as opposed to other places that don't have the ability to do that. So I think, it's a great Canadian company. It's been around for a long time. And so I really like it. And I think that there's opportunities over the long term here for it to grow quite substantially.
So you own, on behalf of clients, shares of First Service, Zoetis, Novo Nordisk, and several of the Canadian and U.S. banks. Do you own any of those stocks personally, or do your family members?
I own them personally, and my family members own them as well. So yes, we own them for our clients. We own them for our myself and I'm invested in my portfolio fully. So I own them for myself and my family as well.
Okay. Very quickly, we only have about 60 seconds left. What sectors of the market would you be avoiding right now, or are you avoiding right now?
Well, so I come back to this issue that there's people would say you don't want to be in tech or something like that. We actually have a lot of tech stocks. So I would say that it's much more company specific. And I think that what you have to do is look at the businesses that you like, try to understand what kind of companies that you want to be in. I certainly wouldn't be, we've never been in resources, so I wouldn't certainly want to be in oil and, we do own CNQ actually, but I wouldn't want to be in things like metals and mining. I think they're going to have a difficult time because they're highly cyclical, and I think you're going to see them continue to fall as if we go into a recession. But I think it's an opportunity. This is the opportunity you have as an investor, and it happens a few times that you get this chance to buy something at a great valuation that you really like. So this is the time to go and do that. And I think if you do that, you have a long-term time horizon, you will grow your wealth quite considerably over the next several years. And that's not only in equities. Obviously, in the debt market, you can do that today because certain parts of the debt market are yielding substantially higher, whether it's corporate debt or even high yield debt, spreads have widened out quite considerably. So there's opportunities all over the place in those asset classes. And like I said this earlier on, because the treasury yield in the short end has gone up so much, it offsets buying these risky assets. But also what happens is the baby gets thrown out with the bathwater sort of thing. And so that, to me, is the opportunity to be able to take an opportunity and look at what's happening out there and say, oh, I really like this company. I've liked it for a long time, but it was too expensive. And today I can buy it relatively cheap and maybe even cheaper. But, so I think that's what you have to do. And I think you won't regret that 2 years from now. You will regret it if you don't do something.